Look, I need to talk to you about something that's been keeping me up at night. And I'm not the only one. There are conversations happening behind closed doors in Washington and in lower Manhattan and Basel that the general public isn't privy to. Conversations about a financial system that looks stable on the surface but is hiding some truly alarming vulnerabilities underneath. Let me start with a question that I keep hearing everywhere. Why hasn't the stock market crashed yet? It's December 2024, heading into 2025, and by all historical metrics, we should have seen a major correction by now. The signs are everywhere: record corporate debt, extreme valuations, a banking sector sitting on hundreds of billions in unrealized losses, commercial real estate teetering on the edge, and yet the S&P 500 keeps pushing near record territory. The Nasdaq keeps climbing. Bank stocks rallied 23% this year after the chaos of 2023. So, what's going on? Is this sustainable? Or are we watching the financial equivalent of a cartoon character who's run off a cliff but hasn't looked down yet? Let me walk you through what I've been studying, what the data actually shows, and why I believe we're in one of the most precarious moments in modern financial history. First, let's talk about the banks, because this is where the story really starts to get interesting and, frankly, quite disturbing. In March 2023, we watched Silicon Valley Bank collapse in a matter of days. Then Signature Bank went down, First Republic followed. It was the second largest bank failure in United States history, and it sent shockwaves through the entire regional banking sector. For a few weeks there, it looked like we might be heading into a full-blown financial crisis, something reminiscent of 2008. But then something remarkable happened. The Federal Reserve stepped in with an emergency lending program called the Bank Term Funding Program. Essentially, the Fed told banks, look, if you're sitting on bonds and securities that have lost value because interest rates went up, don't worry. We'll lend you money against those securities at their original face value, not their current market value. It was a lifeline. And boy, did the banks grab onto it. Here's what most people don't know: 1,804 depository institutions tapped that program. That's not a typo. 1,804 banks needed emergency funding from the Federal Reserve, and 95% of them were small institutions with less than $10 billion in assets. These aren't the J.P. Morgans and Bank of Americas of the world. These are your community banks, your regional players, the backbone of small business lending across America. Now, the program officially ended in March 2024, but here's the kicker. Some banks actually exploited it as quote-unquote easy money. They'd borrow from the Fed at lower rates and then park those funds right back at the Federal Reserve to earn higher returns. It was regulatory arbitrage at its finest, free money courtesy of American taxpayers. But let's dig deeper into what the banks are actually hiding, because emergency lending is just the tip of the iceberg. As of December 2024, banks are sitting on $481 billion in unrealized securities losses. Let me put that in perspective. That's 8.6% of the fair value of all their securities holdings and almost 20% of their aggregate equity capital. In the fourth quarter of 2024 alone, these losses jumped by $117 billion, going from $366 billion to $483 billion. Now, you might be thinking, okay, but these are unrealized losses. The banks haven't actually sold these securities, so it's just paper losses, right? Technically, yes. But here's the problem. If depositors get nervous and start withdrawing their money en masse, like what happened with Silicon Valley Bank, banks might be forced to sell those securities to raise cash. And the moment they sell, those paper losses become very real losses. Suddenly, you don't have enough capital to cover your deposits. That's when the FDIC comes knocking, and that's when banks fail. In the first quarter of 2024, 50 banks had unrealized losses that exceeded at least 50% of their capital equity. Think about that. Half their capital cushion gone if they had to liquidate their securities portfolio. But wait, it gets worse. Let's talk about commercial real estate. Over the next 2 years, more than $1 trillion in commercial real estate loans are coming due. $1 trillion. Banks currently have about $3 trillion of their assets tied up in commercial real estate loans. That's double what they had back in 2012. And the situation is particularly dire for smaller and regional banks. They're almost 5 times more exposed to commercial real estate than the big banks. Why is this a problem? Well, commercial real estate has been in a death spiral since the pandemic. Office buildings are sitting half empty because everyone's working from home. Retail space is struggling because of e-commerce. Even before the pandemic, the sector was showing cracks. But COVID-19 accelerated trends that were already underway and basically pushed the industry off a cliff. Property values have plummeted. Vacancy rates have soared. And now all these loans that were made when times were good are coming due and they need to be refinanced. But here's the catch. They're being refinanced at much higher interest rates than the original loans. A building that was cash flow positive at 3% interest suddenly becomes a money pit at 7% interest. Borrowers can't make the payments. They default. Banks take losses. How bad is it? As of the first quarter of 2024, 67 banks have exposure to commercial real estate that exceeds 300% of their total equity. 300%! That means their CRE loans are 3 times larger than their entire capital base. If even a fraction of those loans go bad, these banks are insolvent. And remember, smaller and regional banks are the ones most exposed here. The same banks that were lining up for emergency Fed funding last year, the same banks sitting on massive unrealized securities losses. You're starting to see how all these threads connect, right? We're not talking about isolated problems. We're talking about systemic vulnerabilities that are all pointing in the same direction. Now, let's zoom out and look at the corporate sector. Because while banks are hiding their balance sheet problems, corporations have been on an absolute borrowing binge. Total debt among rated non-financial United States companies hit a record $8.453 trillion in the third quarter of 2024. $8.453 trillion. Let that sink in for a moment. Corporate America is more leveraged than it has ever been in history. In 2024 alone, corporations issued more than $1.4 trillion in investment-grade bonds. It's on track to be the second busiest year ever for corporate debt issuance. And if you look globally, governments and companies borrowed $25 trillion from markets in 2024. That's $10 trillion more than the pre-COVID period. Why the borrowing spree? Low interest rates during the pandemic made debt incredibly cheap. Companies figured, why not load up on cheap money while it's available? They used it for everything. Share buybacks, acquisitions, capital expenditures, and yes, just refinancing existing debt at lower rates. But then the Federal Reserve started hiking rates at the fastest pace since the 1980s. And suddenly, all that debt isn't so cheap anymore. Companies that borrowed at 2 or 3% now have to refinance at 6 or 7%. The interest expense alone is eating into profits. And we're already seeing the cracks. Corporate debt defaults soared by 80% in 2023. 153 companies defaulted, up from 85 in 2022. These aren't just small fly-by-night operations. We're talking about established companies with credit ratings that couldn't handle the new interest rate environment. Here's what worries me. a lot of this debt is coming due in the next few years. When companies have to refinance at these higher rates, some of them simply won't be able to afford the payments. You'll see more defaults, more bankruptcies, more layoffs. And if enough companies start defaulting, guess who takes the losses? The banks that lent them the money. And we're right back to the banking sector problems I was just talking about. It's all connected. Banking stress, commercial real estate exposure, corporate debt levels, these aren't separate issues. They're all part of the same fragile system, and they all amplify each other when things start to go wrong. Now, let's talk about something that's been dominating headlines and driving market gains. Artificial intelligence. Since ChatGPT launched in November 2022, AI-related stocks have accounted for 75% of S&P 500 returns, 80% of earnings growth, and 90% of capital spending growth. The Magnificent Seven, Apple, Microsoft, Google, Amazon, Meta, Tesla, and NVIDIA, now control 37% of the entire S&P 500, 37%. To put that in perspective, that concentration is 17 times larger than what we saw during the dot-com crisis. Let me repeat that. The current level of market concentration is 17 times worse than the dot-com bubble. And there are some really concerning patterns emerging. There's speculation about circular financing schemes that are artificially inflating valuations. Here's how it works. NVIDIA announces it's investing $100 billion in OpenAI. OpenAI then turns around and uses that money to buy chips from NVIDIA and AMD. It's vendor financing disguised as an investment. The money goes in a circle, but stock prices go up at every step along the way because markets see these billion-dollar deals and interpret them as validation of the AI boom. Is there real value being created in AI? Absolutely. The technology is transformative. But are current valuations justified? That's the million-dollar question. Or rather, the trillion-dollar question, given the market caps we're talking about. The Shiller PE ratio, which is a measure of how expensive stocks are relative to their earnings over the past 10 years, currently stands at 34.4. The 20-year average is 26.6. The only other time we've seen valuations this stretched was right before the dot-com bubble burst in 2000, and we all know how that ended. But here's the thing about bubbles. They can keep inflating long past the point where they seem rational. As one analysis I read recently pointed out, valuations are a poor predictor of short-term price performance. Expensive investments can and often do get more expensive. The market can stay irrational longer than you can stay solvent, as the old saying goes. So we have this situation where fundamentals look worse than they did 7 months ago. Corporate debt is at records. Banks are stressed. Commercial real estate is in crisis. But asset prices keep going up. Stock valuations are at historical extremes. There's a massive disconnect between what the underlying economy is doing and what financial markets are pricing in. Which brings me to the Federal Reserve and monetary policy, because the Fed is really the puppet master behind all of this. In December 2024, the Fed made its third rate cut of the year, bringing rates down to 4.25 to 4.5%. On the surface, that sounds like good news, right? Lower rates should support the economy, make borrowing cheaper, keep the party going. But here's what changed. The Fed also released updated projections showing they now expect to make just 2 rate cuts in 2025. Back in September, they were projecting 4 cuts. So they've cut their outlook in half. Why? Because inflation is proving stickier than expected. The Fed raised its inflation estimates for 2024 to 2.4%, headline and 2.8% core inflation. And here's the real kicker. Fed members now think it will be 2027 before inflation falls back to their 2% target. 2027. That's 2 more years of elevated inflation. At the same time, they boosted their GDP growth projection to 2.5% for 2024, which is actually pretty strong. So we have an economy that's growing faster than expected, but inflation that's not coming down as quickly as hoped. This puts the Fed in a really tricky position. If they cut rates too much or too quickly, they risk reigniting inflation. But if they keep rates elevated for too long, they risk tipping the economy into recession and potentially triggering the very financial crisis that everyone's worried about. Remember all those problems I mentioned? The banking sector stress, the commercial real estate crisis, the corporate debt bubble. High interest rates make all of those problems worse. Banks' unrealized losses grow larger when rates are high. Commercial real estate becomes less affordable to finance. Corporate debt becomes more expensive to service. The Fed is essentially trying to thread a needle, keep rates high enough to control inflation, but not so high that they break something in the financial system. And given all the vulnerabilities I've outlined, that needle is getting smaller and smaller. So let me bring this all together. Why hasn't the stock market crashed yet? There are a few key reasons. First, the Fed's emergency support programs prevented the banking crisis of 2023 from cascading into something much worse. When SVB failed, the Fed moved fast. They provided liquidity. They backstopped deposits. They prevented contagion from spreading. That bought time. Second, corporate earnings, especially among the big tech companies driving the market, have remained strong. As long as Apple and Microsoft and Nvidia are printing money, their stock prices can stay elevated. And since these companies make up such a huge portion of the major indices, they can carry the entire market higher, even if smaller companies are struggling. Third, there's powerful market psychology at play. FOMO, fear of missing out. Everyone sees stocks going up and thinks they need to get in before they miss the rally. That creates momentum. Money keeps flowing into index funds and retirement accounts, and that money has to go somewhere. It flows into stocks, pushing prices higher, which attracts more money, which pushes prices higher still. It's a self-reinforcing cycle. And fourth, financial conditions overall remain quite accommodative. Credit is available, liquidity is plentiful. As long as money is flowing freely through the system, it papers over a lot of underlying problems. Markets don't crash when there's plenty of liquidity sloshing around. But here's what the banks and the broader financial system are hiding. $481 billion in unrealized securities losses that could become very real very quickly if depositors get nervous. $3 trillion in commercial real estate exposure, with $1 trillion in loans maturing over the next 2 years, and property values in free fall. 67 banks with CRE exposure exceeding 300% of their equity, operating in what's essentially a regulatory danger zone. Heavy reliance on emergency Federal Reserve programs that have now ended, leaving many smaller banks exposed. And circular financing schemes in the AI sector that are inflating valuations beyond what fundamental value would support. Add it all up, and you get a financial system that looks stable on the surface but is actually quite fragile underneath. We're walking a tightrope. The market stays aloft through momentum and liquidity, but there are significant hidden risks lurking just below the surface. Now, does this mean a crash is imminent? Not necessarily. Markets can remain overvalued for extended periods. The Fed might successfully engineer a soft landing. Corporate earnings might stay strong. The commercial real estate crisis might resolve without widespread bank failures. AI might justify its current valuations, but it also means we're in a high-risk environment where a shock, any shock, could trigger a rapid unwinding of these imbalances, a geopolitical crisis, a major corporate bankruptcy.
A cluster of bank failures, an unexpected spike in inflation forcing the Fed to hike rates again, a bursting of the AI bubble. Any of these could be the catalyst that finally causes markets to reprice risk.
Here's what keeps me up at night. There's a widening disconnect between elevated economic uncertainty and low financial volatility. Markets are pricing in a very benign scenario: Goldilocks economy, controlled inflation decline, no recession, steady corporate profits. But the underlying fundamentals suggest much higher uncertainty than what's reflected in asset prices. When markets are priced for perfection, any deviation from that perfect scenario can cause dramatic repricing. And the more elevated valuations are, the further they have to fall when that repricing happens. We saw this in 2000 during the dot-com crash. We saw it in 2007 leading into the financial crisis. We saw it in early 2020 when COVID hit. In each case, markets were priced for continued good times, and when reality intruded, the adjustment was swift and brutal. The question isn't whether these imbalances exist. The data clearly shows they do. The question is when and how they'll resolve. Will it be a gradual adjustment, a slow deflation of excess as the economy works through its problems, or will it be a sudden, disorderly crash as multiple dominoes fall in rapid succession? I don't have a crystal ball. Nobody does. But I can tell you this: the warning signs are flashing bright red across multiple dimensions of the financial system: banking sector stress, commercial real estate crisis, record corporate debt, extreme valuations, market concentration at historic levels, a Federal Reserve caught between controlling inflation and preventing financial instability. These aren't hypothetical risks. They're real, they're measurable, and they're all happening right now, simultaneously. The fact that markets haven't crashed yet doesn't mean they won't. It just means the catalyst hasn't arrived yet. Or perhaps more accurately, it means the financial engineering and central bank support that's been holding everything together hasn't failed yet. But here's the fundamental truth about financial markets: imbalances always eventually correct. Always. Unsustainable trends don't continue forever. Trees don't grow to the sky. And when you have this many problems building up across this many different parts of the financial system, history tells us that the correction, when it comes, is usually larger and more painful than people expect. The banks know this. The Fed knows this. The sophisticated institutional investors know this. That's why there are those closed-door conversations I mentioned at the beginning. People at the highest levels of finance and government are very aware of these vulnerabilities. They're trying to manage them, trying to prevent a crisis, trying to engineer that soft landing everyone hopes for. Will they succeed? Maybe. The financial system has proven remarkably resilient over the years. We've dodged bullets before. Central banks have gotten very good at intervening to prevent crises from spiraling out of control. But I'll leave you with this thought. Every major financial crisis in history was preceded by a period where experts assured everyone that this time was different, that we learned from past mistakes, that the system was fundamentally sound. And every time those assurances proved wrong, not because people were lying, but because the complexity of modern financial systems makes them inherently unstable. Too many moving parts, too many interconnections, too much leverage, too much that can go wrong. Right now, in December 2024, we're in that eerie calm before the storm might hit. Markets are near record highs. Banks are reporting profits. The economy is growing. Everything looks fine if you only look at the surface. But underneath, the foundation is cracking. The banks are hiding hundreds of billions in losses. Corporate debt is at record levels. Real estate is in crisis. Valuations are stretched to historic extremes. And the Fed is running out of room to maneuver. So, why hasn't the stock market crashed yet? Because crashes don't happen on a schedule. They happen when confidence breaks, when the illusion of stability shatters, when one problem triggers another in a cascade that becomes impossible to control. We're not there yet, but we're closer than most people realize. And when it does happen, the question won't be, why did it crash? The question will be, how did it stay up for so long